Here's the good news. America is getting back to normal. The bad news might just be sticker shock. Hi everyone, and welcome to The Income Generation. I'm your host, David Scranton. As summer nears, the U.S. economy continues to rebound from COVID-19. As you know, people are eager to get out, have fun, take vacations. And they're also eager to spend, and that's good for the economy. But there is a downside, and you've probably been hearing about it a lot, or even feeling it yourself. And what I'm referring to is the I word, inflation. Today, prices are rising faster than any time since 2008, according to the Labor Department. So how bad could it get, and what might it mean for your retirement plan? Well, we're going to be giving you the scoop on today's show. Are you ready for inflation? And today in the show, we're going to be covering what's driving today's price hikes, how inflation could impact your investments, the risks of inflation in retirement, and also how investing for income helps you. To paraphrase Gerald Ford, whip inflation now and in the future. And helping me out as usual is income specialist and best-selling author Jeff Small. We're also going to be talking to our special guest, Greg McBride. He's Senior Vice President and Chief Financial Analyst at Bankrate.com. And later in the show, we'll hear from some income specialists such as Andrew Agemy from Connecticut and Eddie Ghabour from Delaware. And as always, we'll answer your retirement questions. But first, let's take a look at why inflation is such a hot topic. Now, as you may know, the textbook definition of inflation is too much demand chasing too few goods and services. In a way, inflation is like a very potent spice. A little bit can make your dish a huge success. Too much can give you heartburn. And a little inflation is seen as being a good thing. Why? Because it means consumers are consuming. And that fuels demand, which creates jobs, it drives growth, and overall signals a thriving economy. However, there are always concerns about a backlash, because if prices rise too fast, people may get scared, they may stop spending, and this can bring the economy to a grinding halt. And that concern is on the rise in households and corporate boardrooms across the country. In fact, a recent Shopkick survey found that 77% of Americans are feeling inflation, and 54% of Americans are very concerned about it. In fact, Google searches for the word inflation are at an all-time high. So not surprisingly, all this worry has triggered some stock market volatility. Now, the driving forces behind today's inflation spike are in large part obvious. As COVID-19 infection rates have fallen and the pandemic restrictions have eased, people are chomping at the bit to get back to normal. And in our country, that means spending money. And at the same time, many companies are still recovering from disruptions in this thing we call the supply chain. It means all the things that supply all the raw materials these companies need to make their goods and services. This disruption of the supply chain that was actually caused by the pandemic. So inventories of lots of goods are actually low. Other businesses are short-staffed and struggling to fill open jobs. Restaurants and hotels are probably the greatest examples there. So put it all together and you have too much demand, too much money chasing too few goods and services, AKA inflation. But the question becomes, is all that worry really warranted? Well, we'll talk about that coming up in just a bit. And before I welcome Jeff, let me take a moment to answer one of your questions. Dana from Minnesota says, I'm sorry, Dana, for making fun of how everybody local likes to pronounce the name of your state. In terms of investing for income, you ask, what are the pros and cons of taking a lump sum pension payout? That's a doozy. Well, the pro is that you have control of your money. The pro is that if there's some money left when you die, your heirs get it. Whereas in a pension, you oftentimes will get a little bit more income, but you're also spending principal. Also, if you take the pension income options, you cannot change them. You cannot increase your income. You cannot decrease your income. and nothing goes to your heirs when you're gone. So essentially, a lump sum option gives you a lot more flexibility if you can deal with just a wee bit less retirement income. So Dana, thanks so much for the question. Appreciate it. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. And now it's time to bring in Jeff Small. And Jeff, it's you're looking forward to it. I guess we got a couple weekends from now. We have a little fishing event together. It's been a while since you and I have actually fished on the same boat together, probably 6 months. So hope you're looking forward to it. I am.
I'm going to look forward to watching your arm break, catching all those big fish. That's going to be pretty fun. So listen, Dave, listen. Consumers today are incredibly concerned about inflation more than ever before. And so what they all want is a growing economy, but not higher prices. But it's just like this. Let's break it down really simple for the folks that watch the show and listen to the show. 3% average inflation over 10 years, that same dollar at the end of that 10th year is worth 62 cents. And so whether inflation is real or not, we need to prepare for that in retirement. Don't you think?
Oh, of course. And we've had inflation 2% or even a little less in recent years, so we've been a little spoiled. And I don't think neither you nor I think we're going to go back to a late 70s, early 80s inflation. But bottom line is, to some extent, everybody needs to plan for it. Again, the difference in how people plan for it really depends upon what their goals are and how much inflation will affect them as individuals.
Well, I think they should be more emphasizing on the loss of purchasing power on their retirement dollars, because retirees live on a fixed income. And so they have to make sure whatever savings they have can usurp that rate of inflation. And generally, fixed income investing, we know, as we always talk about, is a phenomenal way to do that.
Yeah, with the right strategy. That's right. With this right strategy, making swaps and engineering inflation in that way, something I'm sure we'll talk about later in the show. But how about the Fed? What's the biggest fear about the Fed right now and how that affects inflation? Think about it.
Well, the Fed really, nobody wants to see the Fed make a mistake and cause the economy to go into a downturn. If they decided to raise rates or pull back on their monetary stimulus too soon and they cut the cord and taper, so to speak, then that could cause a backlash in the economy, and then earnings won't grow, inflation won't grow, and we could have the opposite. Now everybody's going to have somewhat of an inflationary mindset, but no growth on their money.
And, we would argue, I've heard you say this before, that many would argue that the Fed has created a lot of recessions and a lot of stock market pullbacks by tightening too much too soon. So I guess, Jeff, the good news is right now they seem to be aware of that, and they seem to be pushing it down the road. And of course, the risk of that is that inflation gets more and more out of hand if they don't tighten quickly enough. So investors have a lot to be concerned about one way or another, for sure. And Jeff, I can't wait to ask our guest in the next segment about that, somebody whom I know you have a lot of respect for, and that's Greg McBride. He's Senior Vice President and Chief Financial Analyst at Bankrate.com. So looking forward to that. But we're also going to be talking more about Wall Street's fear of inflation and what it could mean for your money. All that and more right here on The Income Generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.
Welcome back to The Income Generation. I'm David Scranton, and today we're examining the question, are you ready for inflation? And so far, we've looked at what's driving the current inflation spike. And now, let's talk more about what it could mean for the markets and for your investments in the near future. As I mentioned, we saw some stock market volatility in the middle of May, a volatility that, frankly, most analysts blamed on inflation. And of course, inflation is usually seen as a negative force on the market for several reasons. First, it increases borrowing costs and output costs for things like labor, materials, and it may eventually decrease consumer spending as prices go up. But most importantly, it reduces expectations for earnings growth. And this puts downward pressure on stock prices. So, of course, the big question is, will inflation continue to rile the current market? Well, nobody knows for sure. But here are some important factors to keep in mind. First, please remember that the stock market doesn't react to economic trends. It actually anticipates those trends. And that being the case, investors typically expect a certain amount of inflation each year, and they adjust their projected returns against expected inflation. Since the markets quickly stabilized after May's volatility, it could actually mean that investors have now priced inflation into this market and have made their peace with it. The other important point is that Wall Street tends to react much more negatively to inflation when the economy is contracting than when the economy is expanding, like now. My own read is that the inflation we're seeing now is transitory. It's temporary, not permanent. And a lot of big investors are obviously agreeing. The high demand behind it, I believe, is pent-up demand caused by the pandemic. Once consumers get it out of their systems, that is this extra spending, prices should stabilize again in a few months. Of course, anything is possible in this age of economic uncertainty. And of course, we'll be talking about that more coming up in just a moment. But now let's get to another one of your questions. This one's from Terry in Vermont, who says, Dave, interesting show, but I've heard some analysts predict that we could eventually have deflation. How could that happen? Well, Terry, it could happen because we've had a cycle since the financial crisis of decreasing demand for goods and services. Why? Because we have an aging population, and they're not going to spend more money that they really can't afford to just because the Federal Reserve has teased them with the drug of short-term interest rates. So lower short-term interest rates, lower long-term interest rates. So the reality is that, that could very easily come back. And if that comes back, our real long-term enemy might be deflation, not inflation. So Terry, thanks so much for your question. And I'm happy, of course, to answer all of your financial questions. Just email me right here at AskDave@theretirementinComeStore.com. But now it's time to bring back in Jeff, and also to welcome our special guest, Greg McBride. He's a Senior Vice President and Chief Financial Analyst at Bankrate.com. And most importantly, he's a friend of the income generation. Greg, thanks so much for being back with us here on the show.
Great to be with you. Thanks so much for having me.
Greg, it's so great to see you. We haven't chatted in probably over a year on the show, but we hear all this talk today about inflation being transitory. And the only thing I see transitory is our money out of our wallets is transitioning faster because the cost of everything is going up. When does this end?
Well, that's the operative question right now. Is this inflation temporary, as we often see in the early stages post-recession, as an economy starts to rebound? You often see these bursts of inflation. Or is it something that's going to be longer lasting? The fact is, we're not going to know for many months as to whether the definitive answer to that question. There are risk factors in play that could make this a more sustained increase. And I think the reality of it is inflation is probably, even once the dust settles, inflation is still going to be increasing at a rate higher than what we had grown accustomed to over the last decade. The last decade, inflation couldn't get above the 2% mark. I think over the coming 5 years or so, I think more in the 2.5% range is going to be the new normal we'll have to get used to.
Well, that's interesting. The Fed has thrown everything, including the kitchen sink. Their policies are completely overdone in terms of the financial stimulus, and that's what's exacerbating this massive move in goods and services and also asset inflation as we speak. And so I kind of see this, Greg, as maybe ending up like the tulip craze, where everything just got to be so expensive, all of a sudden demand just stopped and then prices fell. And that's what I think they mean by transitory. Do you think that's correct?
Well, I think we are seeing some tulip-like manias in some areas of the markets. But as pertains to inflation, we are seeing a burst now. Some of that is due to what's called the base effect. In other words, this time a year ago, price levels were declining. So when you look at it on a year-over-year basis, it looks like a much bigger increase. When you look at it relative to 2 years ago, all of a sudden it's not as unsettling. You've got a lot of pent-up demand. There are a lot of supply chain constraints. Those are the type of things that will work their way through. And that's why I said it's going to be a number of months before we really get a true read. Inflation numbers are going to be a bit unsettling for the next few months. I think it's once the dust settles on a lot of this stimulus, then what do we see? That's going to be more telling in terms of what the trend is going forward.
Well, I don't even think the Fed cares about the inflationary factor. I think they've got an inside bet. They're all shaking hands saying, we're going to go out there and create inflation because we were never able to do it. And so we're going to throw so much stimulus at this that we're going to make sure the economy expands rapidly. And what happens then? At some point, the party's going to end because they're going to taper. And so where do you think at some point the Fed could make a mistake and overcorrect the economy and or taper, Greg?
Well, I think right now the risk is, as you said earlier, they got all this stimulus going. Do they overheat the economy just by virtue of all the stimulus? And then there's the other side of the equation, which is when do they start dialing that stimulus back? And do they do so too quickly, or are they behind the curve? With regard to the tapering, dialing back those bond purchases, they've said to this point, they're not even thinking about it, but they are thinking about talking about it. And that's the first step. I do expect that later this year, we are going to hear something from the Fed, and it is going to cause some choppiness in markets when that happens. Now, markets love the fact that the Fed is so stimulative and that they've been keeping long-term rates low. Even a whisper that they're looking at dialing that back, that is going to lead to some volatility like we kind of been lulled to sleep and haven't seen in a few months.
Now, it's interesting, Greg, you mentioned we have the tulip mania occurring in some certain asset classes. And that's what I'm looking at. So I'm thinking inflation's more transitory because every time they try to create inflation since 2008, what basically happens, we create asset inflation, not inflation for goods and services as we think about it. But you seem to think it's a little bit of a longer term inflation, from what I heard, not necessarily transitory is your best guess. So what's different this time?
Well, I think what's different is that the Fed has changed their mandate. And so in the past, when inflation would start to perk up, that's when they would start to raise interest rates or dial back the stimulus. And now they've said, you know what? Even once inflation picks up, we're willing to let it run hot for a while, because what we're really watching is the labor market. They want to close the gap on that 7.8 million jobs that we're still shy of from pre-pandemic levels. That's really the big number that matters. And if they're late to the inflation game, so be it, as far as they feel like the economy's back close to full employment.
So really quick then, bottom line is if they do start to raise rates in a couple of years because they see inflation, then maybe after a couple of years from now, that's when you might see inflation start to come down to what we've seen over the last decade. Is that what I'm hearing?
Well, I think that we are going to see inflation even once it dies down. I think we're in a transitory phase, but we are going to have to get used to inflation in more in the 2 to 2.5% neighborhood, as opposed to the 1.5%, 2% neighborhood that we saw over the last 10 years. I think it's going to be enough to keep the Fed on the sidelines for a while longer. So, we will get to enjoy these low rates, for at least the next 12, maybe 18 months.
Interesting. Well, Greg, we'll have to have you back because I'm looking at getting back into the 1% something range, although one of our portfolio managers disagrees with me. He thinks it's going to be a little bit longer term as you do. So we'll have to have you back and talk further. Thanks so much for being here. We appreciate it. Great as usual. And coming up after the break, we'll explain why inflation is one of the biggest threats to your retirement dollars and what you can do about it. Plus, we'll talk to income specialist Andrew Agemy from Connecticut, and all that straight ahead right here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to The Income Generation. I'm David Scranton, and thanks for tuning in as we take a close look at inflation and how to get prepared for it in retirement. And so far, we've discussed the current inflation spike that's been happening and what it could mean for the financial markets. But next, we'll take a broader look at inflation and how it could affect your retirement goals. So, while the immediate effects of inflation are always obvious, the long-term effects are much more subtle and therefore can be more dangerous. And that's particularly true when you're retired or close to retirement, because at that stage of life, inflation hits you harder than it did when you were younger. And this exists for many, many reasons. One, is simply that you can no longer count on a cost of living raise from your source of employment to keep up with inflation. Nor can you always count on it with your Social Security check. Why? Because the annual cost of living adjustment in that check is based upon an inflation measure by the CPI index, not the CPIE. That's a separate index that actually more accurately measures the impact of inflation on people 65 and over. You see, some years there's actually no cost of living increase for Social Security. And even when there is, it's usually negated by increases in the costs for Medicare Part B. So they kind of giveth with one hand and taketh back with another. In fact, not long ago, the LIMRA Retirement Institute created a model to show the effects of inflation on the average Social Security benefit over a 20-year period. And it found that a 1% inflation rate would eat away over $34,000 worth of spending power from your average Social Security benefit. At 3% inflation, it would swallow up more than $117,000. Now, historically, the average inflation rate is about 3.5%, which makes the LIMRA model actually conservative. However, it's also conservative in another sense. It measures the effects of inflation really over just 20 years. And here's the reality. You, as I'm sure you're aware, if you're a regular viewer, listener for the Income Generation, is that you need to plan for up to 30 years of retirement income, not 20, and to gauge the effects of inflation over that longer period. So here's the good news. It can be done. And the solution is mentioned right in the problem, and that's income. And we'll talk more about that coming up in just a bit. But now let's get to another one of your questions. James from Tennessee says, Dave, isn't some inflation caused just by companies like drug companies always raising their prices just because they can? Well, James, you're absolutely right, because the reality is inflation is usually because there's too few goods and services and there's too much demand. So when demand goes up temporarily and exceeds the amount of supply of goods and services, yes, they can raise the prices. But eventually more corporations say, you know what, let me increase the ability of goods that we're making or the ability for us to supply services, because we'd rather lower the price a little bit, but get more, get fewer dollars per sale, but get more sales. So short term, you're right, but long term, there seems to be an equilibrium there. So again, James, a great question. Thank you. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomestore.com. Now, Jeff, I know you always have a lot to say, and you're not some wacko conspiracy theorist, but you agree with me that there are issues with how the government calculates the cost of living, the CPI index.
Oh, of course there are, Dave. Well, listen, this is a black and white issue. It's not a partisan issue. First of all, when they calculate the cost of living adjustments, they don't factor in healthcare expenses or energy costs. And that runs really 3/5 of our economy right there is impacted significantly. So there's other types of inflation though, Dave. I consider inflation to be the second biggest threat to retirees' financial stability. However, as we go through retirement, what goes up in price? Health insurance does, but they're on fixed income.
Yeah, no, you're absolutely right. And that's one of the reasons that the CPIE is important, because it has more healthcare costs in there for sure. And the reality is we know that the government always has an axe to grind, right? Because if they publish a high CPI number, then they have to give bigger pay increases to Social Security recipients. They have to give bigger pay increases to people who collect government pensions or hold I-bonds. So with that axe to grind, that's been an issue that we've seen really, forever. It's a little bit like the wolf guarding the hen house, if you think about it. So, and now I actually want to run this by our next guest, someone who's been in the business for several decades, as you and I both have, Jeff, who I'm sure has a lot of great things to say about inflation and how it affects his clientele and what to do to protect themselves. And that is income specialist Andrew Agemy. He's the founder of Agemy Financial Strategies, a retirement income store located not too far from my own office in the great state of Connecticut. Andrew, thanks so much for being back with us here on the Income Generation.
My pleasure, indeed my pleasure.
Andrew, you look like a tall temple of financial wisdom.
But you can't tell how tall I am. I'm sitting down.
Well, I know you're about 6'6", 6'7"?
I was 6'5" in the day, but I'm a little shorter now.
You shrunk. Well, tell us what your biggest concerns are with your clients in relation to inflation. Bestow us your tall financial wisdom.
Oh, right. Well, my clients are very concerned about inflation, and but we are working diligently at trying to make sure that everything is in place for them. Because and one of the great ways to combat inflation, we believe, is to be able to have income, dividends, and interest that can still be coming in and moving forward, and positioning people to be able to buy investments when it's time, and put them in a position, and we're buying the right investments now, so that if inflation comes back big time, well, we'll be good. If deflation happens, well, we're in a good spot. So it's the aspect of diversification is very huge, and being able to take care of them and calm their fears.
So what you're saying then is having an income style versus a growth style is probably a better hedge for inflation at these all-time stock market peaks. Is that what you're telling us?
Definitely. It's always great to have that money coming in. And if you need it, you can spend it. If you don't need it, well, then you can reinvest it. And it's great options.
You really are a tall temple of financial wisdom. I'm really impressed with you, Andrew.
So Andrew, it's funny because as you know, there's two ways to create an inflation hedge when investing for income. One is by being in this universe of bonds and bond-like instruments and just not spending all the income, reinvesting some. The other one is to do it in more dividend-oriented stocks. So tell me about your clientele. What do you find in terms of, are more of them going the dividend-oriented stock route, or more going the bonds and bond-like instruments route? And why do you think that is?
Well, most of my clients are in the bonds and bond-like instruments more than the stocks with the dividend-paying stocks. And one of the big reasons for that is because they are very concerned about what's going out there in the market. My understanding is of the S&P 500, there's about a third of them that are zombie companies, as we call them, that are just indebted. That as long as the interest rates stay low and the stock market goes high, they're able to keep up with the debt service. But that positions them for, if something should happen, they'll be in bad shape. And so that my clients are afraid of that, and they're not that they won't invest in that at all, but that's certainly not the largest portion for them, because they like the aspect of getting that 5-6% of dividends coming in, dividends and interest, and having that coming in no matter what. So that's what they're enjoying. So
real quick, Andrew, are more of the people that you see coming in concerned about inflation, or do you need to educate them about inflation to get them to understand its impacts long term?
I would say there's some of both, because there's a wide spectrum of people, and some of them understand inflation, understand how that works, and some have no clue. And so we're trying to hedge the bets for all of them.
Perfect, thank you. And hey, that previous question, by the way, was self-serving. Since we're kind of sort of competitors, I'm only 20 minutes by car from you, my practice in the shoreline in Connecticut. Since I know you're getting all the people that are conservative and want bonds and bond-like instruments, now I can scoop up all the folks that want to be in higher dividend stocks. So thank you for the competitive intelligence. I really appreciate that. And thanks for being with us as usual.
You're too busy. You're with this television show and everything. You're just too busy for all those companies you have. You're just too busy to help them. So, they need to, get somebody that can actually be there for them,
Thanks again. I really appreciate it. Listen, and coming up, we'll talk more about how investing for income helps you whip inflation now and in the future. And later in the show, we'll talk to income specialist Eddie Ghabour from Delaware. All that and more right here on The Income Generation. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit. Chock full of information you need to know to get steady income during your retirement. Call 866-314-7227. Online at theretirementincomestore.com.
Welcome back to The Income Generation. I'm David Scranton, and it's great to have you with us. Today, we're talking about inflation and how to get ready for it before you retire. And so far, we've covered the current inflation spike and how it might impact the markets. We've also looked more broadly at the risks of inflation in retirement. And now let's take some time and let's talk about how you can manage those risks by investing for income. We've discussed how inflation hits retirees in many cases harder than the general population for a whole bunch of reasons. Another one of those reasons, though, is a lifestyle inflation. And this is a tendency for people to overspend in their first few years of retirement, often called the go-go years, right? A little lifestyle inflation now isn't necessarily bad, so long as you've prepared for it in the same way that you've prepared for other forms of inflation. And in my experience, that means with an income strategy, one that accounts for all the impacts of inflation over a 30-year or greater period of retirement. Once you're investing for income, you have a true strategic approach. And this is crucial. See, income is a more complex goal than growth, so it leaves almost nothing to chance. An income specialist often uses a variety of strategies that can help you keep pace with inflation and hopefully stay ahead of it. One strategy is to help make sure you maximize Social Security benefits, because as we said, they don't always provide an adequate inflation hedge on their own. In addition, many income-based options offer inflation protection that are built in. These can include some types of annuities. They can include real estate investment trusts, business development companies, and dividend-paying stocks, as well as I-bonds. And what's more, your inflation hedge can often be engineered through the strategic reinvestment of interest and dividends that you really don't need for income. Here's the bottom line. Investing for income can offer a much more effective way to whip inflation now and over the long run as compared to investing for growth. So now it's time to take one final question from you. Armand from Wisconsin asks, this isn't about inflation, but I was wondering, is there a way to sort of just dip your toe in investing for income and see if it's right for you? Well, Armand, of course you can. You can always, you don't have to do anything with all your money. You can always start with a little bit of your money. Now, if you're 10 years out of retirement, dipping your toe might make sense. If you're only 2 or 3 years out of retirement, you better dip your toe and your foot and maybe your calf in there, okay? Because you're a little closer, and dipping your toe in the water can get you stuck in a market downdraft that you don't want to be in, okay? So you absolutely can do it, but the extent to which really depends upon where you are in retirement. Now, if you're 10 years out, maybe doing it through high dividend common stocks, that high dividend value strategy we discussed, that might be the way to dip your toe in, because that way there you don't really have to sacrifice growth, but you can start to make that transition. So Armand, great question, thank you. And once again, be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. So Jeff, this whole concept of lifestyle inflation, how sometimes it can blindside people in the early years of retirement, is something I know you deal with every day with your clients.
Well, Dave, it's really interesting because there's a subset of retirees out there who will spend a little bit more than they should because they want to enjoy their lifestyle in retirement. But there's another larger subset that doesn't want to spend as much as they really should be to enjoying their retirement. And so you've got to blend that balance in there somewhere so you can have some fun, because you didn't create all this savings to sit there and just watch it.
Well, it's like a good friend of ours who has a great financial practice out of Oklahoma says, when you retire, you got the go-go years, the slow-go years, and the no-go years. And, the go-go years, God willing, may go into the late 70s or 80, and for some people, it may not even be that long. And that's when you want to spend a little bit more. But you're right. It's obviously important for that reason to make sure you know what your goals are during those go-go years so you can factor in inflation.
Well, goal number one, Dave, should be learn how to enjoy your money. Learn how to keep it afloat. Learn how to just eat the eggs and not the chicken. And that's why we have to work with somebody like an income specialist, who basically is like a chess grandmaster who sees 7 moves ahead so you can enjoy your worth.
I agree completely. And it's, I always make the analogy that if you're a pilot flying at 1,000 feet, you can only see 40 miles ahead. If you're flying at 30,000 feet, you can see well over 200 miles ahead. The horizon essentially is 6 times as far out. And now I want to take a moment. I want to welcome our final guest, Eddie Ghabour. Eddie is an income specialist. He's co-owner of Key Advisor Group in Delaware, and he's also the Amazon best-selling author of the book Common Sense Bull. Eddie, thanks so much for being back with us on The Income Generation.
Thank you for having me. I really appreciate it.
So, Eddie, the dreaded I word is back, inflation, and it's going crazy. So are your clients concerned about that inflationary issue, and are you concerned about their retirement nest eggs due to inflation?
You know, I think everyone should really be concerned with inflation because, frankly, we haven't seen an acceleration on a rate of change perspective on inflation this high in 40 years. Now, fortunately, as I shared with you last time I was on your show, we were positioned for it because we didn't agree with the Fed saying that we were not going to have inflation or 2% inflation. So we did go overweight energy plays and we're positioned for inflation. So rates of return have been fantastic this year because of that rotation. But overall, from a macroeconomic standpoint, the inflationary data is probably what's going to cause this market to really pause and cool off in the third quarter because the Fed's going to finally have to admit that they're wrong again. This is not transitory, and they're going to have to pivot much sooner than what they're leading the market to believe. So we've been able to take advantage of it, fortunately. But our clients, I would say they're more worried about their children than they are themselves because, fortunately, they're doing just fine financially.
Well, if the Fed makes the wrong mistake and changes policy midstream, they could crush the economy and put us into recession and cause the markets to fall. But I don't think they care about inflation, Eddie, because they're so disconnected from reality with all of this crazy stimulus they've done. So when does the Fed taper is the question. What do you think about that?
So I think they're going to start to position the market to prepare for tapering, probably in the July meeting at the end of July. They're not going to truly start tightening, in my opinion, until the first half of next year. Because look, they can ignore it, but ultimately this is a ticking time bomb. And if they don't tighten sooner than later, then you're going to have hyperinflation, which could be just as detrimental or more detrimental to the economy than tightening too soon. So they're going to let it run hot as they already have. But the reality is this is not transitory. Just look at labor costs. So they're going to tighten next year. Not in 2023 like they've led us to believe.
So Eddie, you and Greg McBride are on the same side of the equation, so it's 2 against 1. I think it's transitory. You and Greg disagree. So, all right, if it's going to be longer term then, and you've been fortunate because the stock market's been hot, you've been able to give clients an inflation hedge in the stock market, but what happens to their inflation hedge when they go in this universe of bonds and bond-like instruments? What happens? Because you can create a little bit of an inflation hedge in bonds and bond-like instruments also if you want to pull them out of the market. So how do you do that?
So here's the thing. I think I want to define transitory as well, too, because, you know, we're going to hit peak inflation probably June. At the end of this month, we're going to hit peak inflation. And then we're going to be in a decelerating rate of inflation, but it's still going to probably be in the 3-4 range. So they may refer to that as transitory, but it's still higher than what we've seen in a long time. So I think for bond investors, what will happen is the 10-year will probably top out, and that'll be good for fixed income investors. And so we're going to start becoming we're going to become more defensive in July and August to prepare ourselves for this new cycle, economic cycle that we will be in. So preferreds pay nice dividends. Some of the energy stocks pay nice dividends, and then the fixed income does. But your more cyclical stocks that have worked really well this year that we're overweight in, we will not have much exposure at all because those will be the ones that get hammered when this next economic cycle kicks in, because the Fed is always reactionary.
Yeah. And as you know, in the world of bonds and bond-like instruments, if you actively manage those, you can kind of sort of engineer an inflation hedge because sometimes, you know, 2 bonds of a certain type, one zigs while the other zags. And if you're willing to actively manage it and swap out of one and swap into the other, you can actually engineer a little bit of an inflation hedge as something I know that you do for your clients. So Eddie, thanks so much for being back with us here on the show. It's great to have you as usual.
It's my pleasure. Thank you.
And thank you for joining me once again here on The Income Generation. And a special thanks to Jeff and all of our guests. We've had a great time. Bottom line, if you're close to or in retirement and you're concerned about your money, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.